Tonight, the world's money is moving in two directions at once, out of broad equities and straight into the eye of the AI storm. Oil is whipsawing on oversupply and geopolitics. Washington and Beijing are about to test the red lines again, this time with TikTok and trade hanging in the balance. And the UK, one of the planet's financial hubs, just stalled. If you care about your portfolio, your business, or your next move, you need to hear this now. First, what you need to know in 60 seconds. Global equity funds just saw their first weekly outflow in 5 weeks. Over $3 billion pulled as big players quietly de-risk. At the same time, US indexes hit fresh records on AI momentum and rising odds of a Fed rate cut next week. Oil's stuck in a knife fight between oversupply and fresh disruptions out of the Russia-Ukraine theater. In Madrid, the US Treasury Secretary and China's Vice Premier will meet with trade, national security, and TikTok on the table, days before a US ownership deadline. And the UK's economy? Flat in July. No growth. That's the map. Let's go deeper. Reuters' our first story. The smart money blinked. Global equity funds recorded a net outflow of roughly $3.6 billion in the week ending September 10, the first weekly withdrawal since mid-August. US equity funds took the heaviest hit, with more than $10 billion out, even as European and Asian equity funds still pulled in cash. Sector money didn't panic. Tech, healthcare, and consumer discretionary funds posted net inflows, and bond funds drew another $18 billion, extending a 21-week streak. Translation: broad beta risk is being trimmed while investors rotate toward defensives, cash, and targeted growth. This is classic late-cycle behavior. People keep exposure to the winners and build a cushion everywhere else. The kicker? Money market funds swelled by over $60 billion in a single week, and gold-linked products saw fresh buying. When the cash hoard rises this fast at record highs, it's not complacency, it's preparation. Watch for whether those outflows repeat next week. 2 consecutive prints would confirm the tone shift. Second story, Wall Street's euphoria has a name, AI, and a symbol, Oracle. The S&P 500 and NASDAQ printed record closes this week on the back of cooler inflation signals and a raging bid for anything powering the compute boom. Oracle's shock move, flagging 4 multi-billion-dollar cloud deals and an order backlog tracking toward $500 billion, ignited an AI rotation that lifted chips, infrastructure, and hyperscale adjacent names. Traders are now leaning toward a 25 basis point Fed cut next week, with some whispering about a 50-point surprise. Markets are pricing multiple cuts by year-end. That cocktail, AI capex plus cheaper money, pulls future earnings forward and fattens multiples. It also tightens the spring. When leadership narrows and narratives get this strong, volatility on bad news multiplies. For now, the tape says momentum. The NASDAQ notched fresh intraday highs as Tesla and Micron joined the party, while tech outperformed broadly. But listen closely. Energy, consumer, and industrials lagged on the day, and breadth remains uneven. If you're long the AI stack, you're with the crowd, and the crowd is winning. Just know what you'll do if inflation flips or guidance cools. Reuters' third story, the Madrid test, trade, security, and TikTok in the same room. Next week, US Treasury Secretary Scott Bessent and China's Vice Premier He Lifeng meet in Spain for their 4th substantive sit-down of the year. The agenda is dense: tariff truce management, national security screening, anti-money laundering cooperation, rare earths flows, and the hottest consumer tech flashpoint on Earth, TikTok. Why now? A U.S. ownership mandate deadline is looming on September 17th, and both sides are gaming outcomes, from forced divestiture to extended grace periods. Markets care because every line item here prices into earnings. The cost of capital for China-exposed supply chains, the ability of U.S. firms to sell into China, the availability and price of critical inputs, and the regulatory heat on platforms with global reach. The last rounds of talks bought a 90-day tariff ceasefire set to run out November 10th. Madrid is where both parties decide whether to load costs back into the system or keep the pause while they rewire the rules. For investors in semis, industrials, and consumer tech, the statements after the meeting will be the tell. Reuters' fourth story, oil in a vice, oversupply on one side, war risk on the other. Brent and WTI slid earlier on Friday as inventories rose. The IEA flagged faster than expected supply growth, helped by OPEC Plus, and U.S. demand signals looked soft. Then intraday, prices rebounded on reports of Ukrainian drone attacks disrupting Russian exports. Net, crude is chopping in the mid-60s. Brent has traded between roughly $66.67 plus, WTI in the low 62. What matters is the message. Fundamentals are telling you supply is plentiful and growth is cooling. Geopolitics is reminding you that shock is always one strike away. For central banks, cheaper crude keeps the disinflation story alive. For energy equities, the spread widens between integrated majors with downstream buffers and pure-play E&Ps living and dying on spot. Watch the next U.S. inventory print and any sign of China reacceleration. Either could break the range. Reuters, fifth story. The UK just hit zero. Official data show no growth in July, flat GDP, with weakness across manufacturing and industrial output setting a difficult backdrop heading into the autumn budget. The 3-month growth rate is still positive versus last year, but the monthly stall is the signal. Consumer-facing services faltered in 7 of 13 categories, and confidence is fragile. The pound softened on the print and the policy dilemma hardened. The government wants growth, the Bank of England wants price stability, and markets are pricing how much pain the economy can take without policy support. For Europe more broadly, Britain's stagnation is a warning light on an already narrow runway. If the UK can't find momentum with inflation easing and rates likely to drift down, the bar for a proper European reacceleration rises. For investors, this tilts you toward UK names with global revenue, exporters helped by currency weakness, and defensive cash flow generators until the data improve. ones.gov.uk. What to watch next? 3 needles that move the compass. 1. The next Lipper Flows report. If global equity outflows repeat, you have confirmation that institutions are taking chips off the table even as indexes sit at highs. 2. The Fed meeting next week. A 25-point cut is consensus. A 50-point shock would rip through the curve, growth stocks, and dollar trades fast. 3. The Madrid communique. Any signal on TikTok's fate, tariff extensions, or rare earths guarantees will hit specific tickers and entire supply chains. Positioning is already crowded in AI. Policy headlines are the catalyst that can accelerate it or force a rethink. Reuters' bottom line: the tape is bullish, the money is cautious, policy is volatile. That's not contradiction. It's the definition of late cycle opportunity. Stay long what's compounding now, carry more cash than you think you need, and keep your risk where you can manage it overnight. This has been Global Shift.